The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, real estate investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all. Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.
Welcome, welcome, welcome. Welcome to Primetime Home Buyers, the buyback team. All right, I just want to make sure that you guys can hear me and you can see me. Well, you won't be able to see me today. Today, we're going to be going over trust and taxes. So, if you're part of the buyback team, you know what we're talking about. We have been releasing a series of seminars related to understanding trust. This instrument you can use to house your assets, transfer your assets, as well as receive tax credits, um, and much more. All right. We've been sharing this information. We also have a part one to the trust seminar. Within the seminar that's located on Primetime Home Buyers, and we're going to share that with you. You'll be able to access this seminar. Let's see, let's find our trust seminar. We're going to go into access plans. Once you go into access plans, you're going to see all of the plans in the seminars that we have available for you. Starting from here down are actually all seminars after the full course. And what we're talking about is this trust seminar. We have been doing a series of trust videos, which includes intro seminar, the Power of Trust Part 1, The Power of Trust Part 2, Living Trust Advantages and Disadvantages, Trust Key Elements to Know, Trust Concepts to Remember. What is the role of a trustee? Because you want to know, because you may play the role of the trustee as well within a living trust or a business trust. Living trust, detailed review. Advantages and disadvantages of a living trust. Okay, this is a repeat. I do apologize. This is not supposed to be up there twice. Funding the trust, funding the trust 2-part video. So this is a 2-part video that teach you what goes into a trust, the different instruments, how they're housed, be it tangible, such as money, things like that. So we go into that. Concepts to know about business trust. This is a good breakdown of what you want to know about business trust. And as we talk about, all of this information is for information and educational purposes. And we do ask for you to always seek a professional. On our referral page, we will be updating some more referrals. And we do have a trust lawyer in the state of Georgia. And I wanted to make sure I can add her credentials to the page for you guys. Trust in U.S. Taxes Part A. All right. And that's where we actually left off. So we're going to be doing Part B, which is much shorter because this one was about 1 hour and 20 minutes. And this part is practical steps in setting up a living trust. This is a general introduction to it. We're going to actually show you in real time documents similar to trust documents that you may see and how we set up, example, a business trust or a living trust. So that's going to be the next few seminars that we will be doing. With that goes to say, we're going to get this started. All right, so let me share my screen. And we're starting from the beginning. In the beginning is trust and taxes. This is part two. This is the concepts that we'll be focusing on today, which is trust deferred versus taxable investments. So I do apologize. Tax deferred versus taxable instruments. Interest versus principal distribution. Trust. What are step? What are step up tax base? So we was talking about step up tax base information in the last presentation, so we're going to clarify that a little bit more. Now, the reason why we're going into this, and this is the best time to go into this, is because tax season is coming up. So not only would you learn from this seminar about a little bit about trust, but you'll learn about tax deferred interest accounts. And those tax deferred interest account examples are 401ks, college savings, and things like that based on distribution. Okay. And you can use these particular instruments to help you save on taxes nearly yearly or defer and gain more, basically, build up the principal in the account and allow you to pay less taxes instead of doing it yearly. Okay. So let's get into it. Tax deferred versus taxable investment. What is that? What is tax that is deferred? Deferred tax simply means money that is taxed when funds are withdrawn. With tax deferred account contributions, this can be used as a deductible when filing your taxes. Tax deductions are great financial tools that help investors minimize the contributions and lower their tax liabilities. Some tax deferred accounts are known as IRAs. Now, we're talking about this because when you get into real estate, there are some tax benefits as well, but you still are subjected to some of these taxes yearly. So if you house the money properly based on the monies that you made or the principal versus the interest or what you receive, you'll probably be able to roll over some of the money that you have acquired from selling this property to a next year instead of paying taxes on it this year, and actually have a little bit more to play with and put you in a different tax bracket, and that alone will help you. And I want you guys to talk to a financial expert, okay? But we got to give you some of these concepts. It is common that most tax deferred account allows you to invest your contribution without being taxed until they are distributed, and we do know that. These tax deferment account allows users to eliminate current taxes on the investment gains for that year. It also helps individuals save on their tax in the long term. So you want to have a financial advisor, especially when you're flipping more than one property and your assets is basically increasing because you started with $10,000 investment, and now when you close on that tax lien or tax deed, you have an asset of $150,000, $200,000 home. You see, and all of that money that you made from that home has to be taxed. So you have to know about taxes, not just trust instruments on how to house it. You got to know what to expect yearly. Tax deferred. Keys to know about tax deferral. More money can be in motion and in use by way of investing without being taxed if you use a tax deferral account. Okay, keep that in mind. It is like a it's like a saving Save now, pay later. By the end, the taxpayer have more money, and by the end, the taxpayer having more money taxed together, it can help lower tax liability penalties potentially. You want to look at the current tax code right now, but this is the general synopsis of if you have a bigger bulk of money, you will be able to be taxed at a different tax bracket, as well as if you house that money in investments. As we talked about when we talked about trust and transferring to the beneficiary, we're going to get into it just a little bit. Sometimes trust is taxed when you're doing distribution to beneficiaries, but if you're doing charitable distributions, they may not be trust, so tax. So there's some movements you can make from the trust to other charitable distributions and or investment accounts that will allow you to save a little bit on the taxes, because some people who do this method is going to jump into another tax bracket, and you want to have an expert and you want to have an idea what to expect, because you probably was making $50,000 to $70,000 a year at your job, and as a tax lien investor you can make $150,000 on one deal. So let's keep that in mind. Taxable investments. Taxable investments are investments that are taxed as the income is acquired within the same fiscal year. Okay? Taxable investments. So let's keep that in mind. Rent is something like taxable investment. When you get that, that is something that is taxable. All right. The difference between taxable investment accounts versus deferred accounts is that with the taxable investment account, you may be able to avoid capital gain taxes, which can be very costly. So with real estate, you want to understand what capital gain taxes is. And we're going to go more into detail once we finish our trust series. I do apologize. Um, we're going to go more into capital gain taxes because into January we're going to be doing our taxes here. So we're going to share a little bit information with you about that, because anytime that you do acquire more property, you do acquire some type of monetary gain from a transaction. There is a tax transaction that follows. Interest versus principal distribution. Now, we talked about interest in the principal distribution, and we know that the principal amount of the trust is usually not taxed more than once. And the interest that gains on that trust is taxed if it's distributed, or depending on the state, yearly. Principal distribution on trust accounts are usually not taxed because it is assumed that the money has already been taxed before it entered the trust. Okay? Interest within the trust or any interest acquired within the trust is taxed. Also, in some instances, distribution from trust is taxable depending on what type of distribution, and we mentioned that. Now, if you are transferring a property to another person, you have to, one, know the real estate laws. Also, when you transfer to a beneficiary, usually that person, they just have to be responsible for the upcoming taxes because now they're the new owner. But let's say you transfer the property to them and then they take that property and sell it. Now, just because they had the property from you doesn't mean that they can't pay taxes on their capital gain. And the capital gain will most likely be considered the fair market value of the property, um, versus anything you put in the property, and subtract in the sale. So you'll be basically using those amounts to figure out what was your actual capital gain for the sale, and that will be what is taxed yearly. But if you talk to a tax expert, they may teach you how to take that capital gain and put it into a tax deferred account and have that tax deferred account under your trust, which will house this money for a certain amount of years, depending on the tax code and tax, regulations. They may allow you to roll over for 2 years, and then you have to pay the capital gain or pay the taxes on the interest, which will may be known as something else, not capital gain. Okay. So please keep in mind that if distribution tax is not paid by the trust, it may fall on the beneficiary. The IRS may consider it first time income, and that's what we talk about. Okay. If the trust distribution is related to state transfer, the tax may be paid by the trust. So if it's related to estate transfer, the E, it's not E, it may be taxed by the trust. Okay, as we told you, the last what the trust is responsible for, they have to handle with the trustee. But once it's transferred to you as the beneficiary, it is your responsibility. And those are the kids. That's the person you transfer to. You want to make sure that you're gonna transfer to someone who's gonna take care of your property good or your business. Okay. What are stepped up tax bases? So that's the last thing we're going to kind of hit because we left off on that on the part one. Step up taxes are taxes that are placed on any property that goes through every revocable trust. If you have a revocable trust, it may fall under the step up taxes. So please pay attention. The formula: determine your taxable profit on the property. Now, this is step of taxes. These is if you transferred the property or you sold it. If you sold the property, not transferred. Okay. The formula you'll keep in mind is determine your taxable profit on the property. You want to know that. You want to figure that out. The basis of the real estate is known to be the purchase price. Okay. So we ask, what's the base? What's the purchase price? What are the costs for any improvements? You want to keep that in mind. Did you put any improvements before you sold this property that you got from mom, or and you resold it? Determine if there's any depreciation. Now we know the market is disinflated right now, but in the case if there's any depreciation, you have to get a new appraisal, the most up to date appraisal you can get, and your county can do that for free for you, especially if it's out of date. The total amount of the property was sold for. So you want to know those things, okay? Now, step up tax example. We're going to give you example. The home is purchased for $250,000. Homeowner put $20,000 in improvement on this particular property. The new basis now is valuing about $270,000. Depending on the area, usually, there's more to the equation when they reappraise your home, but any improvements that are qualified to add more equity into your home, you want to look into that in your state and make sure that your home is appraised properly. If the property is sold for $375,000 instead of the 270 that is worth, because the market is inflated, the profit will then be $105,000. You may be able to defer this property through defer this profit through a deferred account. So imagine you as a new tax lien investor, and you literally went from making $70,000 a year. We're just going to talk this out because this is why we're talking taxes. It's serious, and we need you guys to understand this and guide your tax person and be transparent. Don't hide anything. Keep your records, keep copies, and then, I know everybody's not perfect because I'm not. Please track your spending monthly if you can, or every quarter, every 3 months. Go into your books, especially if you have multi businesses. Many people in the last 3, 4 years have started so many different businesses, and we don't want you guys to get caught in a tax game. Y'all see that they're doing a lot of tax changes this year as far as business owners. They're lowering the amount that your tax. They're even trying to implement things such as monitoring PayPal. I know you guys heard that. Don't forget, don't be distracted. If that bill was passed, if you have any transaction more than $600 in your bank account or these type of entities, they're going to report it. So you want to keep a good book as well as pray that we can do cash transactions. Cash transactions. I'm just going to say that. Or anything that's done on a computer, in a bank account, I'm going to tell you it's trackable. So be honorable, keep track of your spending. Now, let's just go off right here. We're going to talk about a little business trust. If you have a business trust and you have a revocable family trust, you need to operate those trusts completely different. With the business trust, you have more flexibility when it comes to distribution, depending on the state and the tax code. Meaning that, like I said, if you're going to take that money and redistribute it in an account that we just talked about, a tax deferred account, it may hold you some tax savings that year because you want to think about how the elite do it. Remember, they said at one point Trump barely paid any taxes, and a lot of these big mobile companies didn't. It's not because they had a little in their bank account, they had a lot. And what that goes to say, the more volume you have, there are some tax benefits and some ways you can separate that money in different accounts, such as what we talked about, or equity within properties and just hold them knowing that once you pay the taxes on that property, you don't have to pay it every year. Your money is secure. It ain't no reason why it should be taxed, nothing. You see, this is why we talk about having trust instruments so you can house certain things, have it regulated a certain way. Have someone who's a trustee that you trust, or you can be the trustee, but you have to operate honorably. Meaning that if you write a trust up and say, every month I have 4 employees, the way, because it's a revocable trust, so you can always upgrade it. But as we start out with this company, we have 4 employees. Each month they get $2,000 or 15% of the amount that they make in sales, i.e., whatever one is greater. Okay. And you'll have that in the trust. And your trust every month will do that for your employees. And you have a section in that trust where the trust as well pay you as an employee and have it set up correctly because any distribution when it comes to employment, these people have to pay taxes. So if you have them as 1099 contractors, you don't have to worry about the taxes. They will. So within the agreement, you have 1099 workers in that business trust. Those distributions right there can be taxed or they may not be taxed because those taxes are going to be paid by the person who received it. So you want to verify that information as well. Great example of business trust and how it operates versus a family trust versus a revocable family trust. Let's say, or let's say, yeah, a revocable family. Mm, yeah, we want to make it revocable. So with the revocable family trust, let's say that you have a child that you want to, i.e., give them a home, $10,000 every quarter when they're in college, and also fund their college. You have to write that trust up in a manner that's going to tell the trustee to do all of those things and give them the direction and the right to do it, and the trustee is supposed to pay the college, release the money based on the terms, because you can add terms to it and say, hey, well, the kid will receive the money if they receive at least a B average on um, each semester, and that will be terms to the trust. So everyone has to be in agreement with the trust. Everyone has to know about the trust as well. We talked about you can't just have a trust and then not have family, like kids, definitely descendants, stray kids, and not give them what they are entitled to as your seed. These trusts can be contested in court. Trust can be made public. This is supposed to be a private instrument, but it can be made public. So these are some of the concepts that we went into today and we went into over this series of seminars. We're going to continue to share more and more information with you. If you have access to the trust seminar, you have access to all the PowerPoints as well as all of the videos on playback, and you can listen and learn at your own pace. I do want to say thank you so much for being part of the buyback team. Thank you for listening and learning and growing and really figuring out how the elite runs. Because what we want you guys to do is to take the place of the people who are causing destruction. Once you have capital and you have assets, you have some power. And we know if you're able to utilize that power correctly, we can change a whole system. So we're going to leave it like that. And I want to say you guys have an amazing Sabbath. You've been beautiful people. And I will see you on Monday.